So today we're shining a spotlight on a crucial yet overlooked aspect of business, which is bookkeeping. While it may not necessarily be a glamorous topic, its importance to your company's success can't be overstated. I can almost hear your thoughts. Bookkeeping, seriously? But don't tune out just yet. This is often an overlooked practice that's actually a secret weapon for many thriving startups. Welcome to Tech Uncensored, everyone. My name is Hessie Jones. So, if you think of bookkeeping, think of it as a GPS for your business journey. Without it, you're essentially driving blind and you're hoping that you're on the right road and not about to careen off a cliff. And believe me, in the startup world, those cliffs are everywhere. So, here's a sobering stat: 29% of businesses fail because they run out of cash. That's nearly 1 in 3. But here's the kicker: many of these cash crunches could actually be avoided with solid bookkeeping practices. But it's really not just about avoiding failure. Good bookkeeping is setting yourself up for success. It's about having the clarity to make some of these smart decisions and having the data to back up some of your hunches and having the financial foundation to actually weather some of these unexpected storms. So today we're going to demystify bookkeeping for startup founders. If you are that CEO who breaks out in a cold sweat when someone mentions balance sheets, we've got you covered. So we'll explore why it matters, what's really involved in bookkeeping, how you can approach it efficiently, and whether you choose to handle it in-house or outsource it. We'll have that covered as well. And I'm happy to introduce Tanvi Gupta, who is a senior manager with Assurance Services team at MMP. And she is going to help me dive into this topic. Welcome, Tanvi.
Thank you, Hessie, for having me here.
No problem. So you are a seasoned CPA, 10 years experience. You specialize with clients across various sectors, from small owner managed, private equity owned, as well as funded companies. So it looks like you've got the experience to help us tackle this topic.
Yes, bookkeeping is my bread and butter, as they say it.
That's perfect. Okay, so let's start. So let's begin with the basics. What is bookkeeping and why is it essential for startups?
In the simplest words, bookkeeping is just a process of recording financial transactions. Think about documenting the flow of money into or out of a business. So that is bookkeeping in a nutshell. And where it comes important for any startup company or any business for that matter, there are a few key topics. Think about financial management. You need accurate bookkeeping so that you can keep track of your cash flow, manage your expenses, and plan for the future. You need that basis of bookkeeping to manage the financials. Others could include funding needs and investor relations. So as a startup, you want to get more funding into your business. You might be looking at introducing new investors into your business. As investors and stakeholders, they would require your financial information to assess the performance, look at the sustainability, the durability of a startup. Hence, you would need the bookkeeping to produce those reports that they're asking for. Any business in Canada also has regulatory compliance. So you would need financial data and financial records to ensure you're in compliance with all the regulatory requirements. The one that comes to mind is CRA. You have an annual requirement to file taxes, for example. Next could be for business planning. You need the history of what your startup has done so far so that you can plan for the future. Therefore, historic data, which will come from bookkeeping, keeping track of all your financial transactions, would be needed so that you can successfully plan for the future. And overall, just risk management. As a startup, you need to maintain accurate financial records so that you could mitigate any future financial risks by having that data on hand.
Okay, that's perfect. Thank you. So we talked earlier about that stat about 29% of startups failing because of financial mismanagement. What are some of the reasons why bookkeeping is overlooked at the earliest stages of starting a business?
Hesse, you mentioned it yourself that bookkeeping is not necessarily glamorous, but there are certain reasons where bookkeeping can be overlooked. And the first one is lack of knowledge. Many startup founders may not have the financial expertise or knowledge that's required for bookkeeping, leading to inadequate records or not sufficient information to do the bookkeeping. There's always resource and time constraints. When we look at startups, initially in early stages, there are limited resources. So it becomes a challenge to hire a professional or someone with any bookkeeping experience to do the bookkeeping and keep track of transactions. Startups are focused on growth, and there are other priorities. So generally speaking, bookkeeping can, take a step back and become something that's in the back of anyone's mind rather than forefront. Hence, it's overlooked. There's also complexities. Depending on what kind of startup person's running, the volume of transactions, the type of transactions could result in complexities. And these complexities are time consuming. So another reason bookkeeping can be overlooked. And I always say that bookkeeping and accounting play catch up to operations and growth. So it's always in the back of everyone's mind. And there's not necessarily a perceived immediate effect or benefit of bookkeeping. Yes, you need bookkeeping, but generally speaking, when there are other priorities, it takes a step back.
That reminds me of the filing that I had to do on my business, and my husband was my accountant. He is my accountant, by the way. And we left everything probably 1 or 2 months before the CRA deadline. We basically did a year's worth of bookkeeping within a month. And I could see that this is something that a lot of founders put on the back burner. They try to avoid it as much as possible. And then when it comes to crunch time, it's a race to try to get it done, right?
Yes.
So
I've seen that more often than not, believe it or not, Tessie.
I know. I see a lot of startups. Do you know who actually can do this for us? Because we need to get our taxes done. And it's seriously, it's like a year's worth of stuff trying to crunch down in within a couple of weeks. So let me dive a little bit deeper. From a startup's perspective, what are some of the hurdles or some of the perceived costs of bookkeeping? Can you lay that out a little bit?
For sure. The first one I would say are the financial costs. It takes funds, resources to hire professionals or a full-time employee to do bookkeeping. And depending on the volume, it could be a costly exercise. So that adds financial burden to a company at a startup stage where you're still in the growth stage, still trying to get the footing. So you don't really have those extra financial resources to hire professional help. Other items could be something like a software. Where are you recording these transactions? If you're doing bookkeeping, you do need tools and software to keep track of the financial transactions. So you could think about, early stage softwares such as QuickBooks, Xero, FreshBooks. These are softwares and accounting platforms that are geared towards small to mid-sized companies, and they do have a financial cost. So software and tools would add onto the financial burden of a startup when thinking about bookkeeping. Training costs. As you grow the business and when you're in those stages, you would need to train your staff, your employees, your teams on keeping track of transactions. what are the what kind of transactions you will be incurring, how they're recorded. So there is a cost that goes into training as well, time and I guess time and materials. So those would be the financial costs of bookkeeping for a startup. But there are other costs that are associated with startups. The administrative burden. Think, as Hesse mentioned, crunch time, everyone's trying to reconcile the books when the taxes are due. There is an administrative burden, a time that's required to record these transactions. And when you are in that early stage or growth stage company, time is a constraint. Opportunity cost. The time spent on bookkeeping could actually be used doing other, working on other priorities or working on other tasks that might be, in the forefront. When we look at bookkeeping, there are also perceived complexities. Learning curve if you don't have the basic bookkeeping knowledge, depending on the type of industry you're in and type of transactions you're dealing with, there might be a steeper learning curve for the bookkeeping to happen. Regulatory compliance. Not everyone's a tax expert, and I wasn't 10 years ago either, but through experience, I've been able to get there. But that is also another complexity. There are changes, whether it be in accounting or tax rules, that are always happening, and keeping track of them can be a cumbersome task. So again, adds on to another level of complexity when it comes to bookkeeping. And not to mention not to forget the psychological costs. Sometimes stress and anxiety can, weave their way in when you're ensuring that bookkeeping is done accurately. And if you don't have enough financial background, there's a fear of mistakes. Everyone, as you're learning and as you're trying to manage different priorities at once, it's human nature to make mistakes. So, but that does add on to the anxiety piece that I mentioned before. And sometimes it's really complicated, or the transactions are really complicated, or there are complexities within the business world, the growth that might further add on. Overall, there are different factors that work together to make bookkeeping a bit more challenging than it needs to be. But there are other ways to, reduce the perceived costs. And this day and age, there are multiple technologies out there that can ease the burden of bookkeeping, such as automation tools. Right now, there are tools that could perhaps record the transactions for you, and you just have to review. Or consider outsourcing. There are professionals that are experts in the area and can help startups do the bookkeeping so that their time can be spent elsewhere, and they're prioritizing tasks that are important to the growth and future of the company. Education and training. Just investing in basic financial literacy, financial training can assist in better understanding the bookkeeping needs of a company, of a startup, and choosing a way forward that way.
Okay. So let me ask you, on average, if you were a startup and let's say your costs are minimal, let's say in the first few months, on average, how much time should you be spending in just making sure your books are updated?
It all depends on the volume of transaction. Hesse, in your example, not many transactions, minimal. I want to say a few hours a month should suffice to catch up with those transactions. So it's not a huge time investment just because there isn't that volume of transactions to record yet.
Right. And I think also from that perspective, when you're just starting out and let's say you don't even have, you're not even thinking about an accounting system, people start off on Excel spreadsheets, right? They start recording expenses from that perspective. And at some point in time, they do have to take the leap into a system that now takes in consideration what's going in, the bank account, what's going out of the bank account, right? And on the credit card.
Yes. So early stages, Excel is your best friend. If the transaction volume is manageable, you're still, in the beginning stages, yes, Excel would be a good tool to utilize to keep track of transactions. And eventually, when the volume is a bit too high, you can consider investing in a small to mid-size software tool. These software tools like QuickBooks, for example, they're very economical depending on what package you get, and you don't need customizations for them. So just investing in a software at that point, once you are at a growth stage where the volume of transactions is too much for an Excel to handle, that's when you could invest in a tool, in a software.
And they're fairly reasonable in the beginning. I know with QuickBooks, they offer you, like, at least when I used it, was like 6 months for free, and then even just to try out the tool, and then eventually your costs kick in. So that's very reasonable. So tell me about the difference between bookkeeping and accounting. And this was refreshing for me because I had no idea about, like, some of these key differences.
So bookkeeping and accounting are related, very closely related, but there are different fields as well. So bookkeeping, as I mentioned before, it's transactional. You're recording day-to-day transactions, the financial data, all the financial dealings of the company. But accounting is taking a step ahead. Accounting is when you take all the data from the bookkeeping processes and you start interpreting and analyzing the data to provide insights and support decision making. So bookkeeping would be step one that feeds into accounting, for accounting to better analyze the data and to help support decision making. So accounting goes beyond bookkeeping, where bookkeeping will provide the data and accounting would classify, analyze, put it in a format that's reportable, and summarize the financial data. So for example, if you look at cash flow of a business, bookkeeping would entail recording the cash inflow from the bank account or outflow from the bank account, while accounting would take that information on the inflows and outflows and try to summarize patterns, try to predict cash flow, future cash flows. So accounting could help with cash flow management, whereas bookkeeping is just recording the data. So bookkeeping, think about bookkeeping as step one, and the next step, which is more involved, which helps decision making, would be accounting.
Okay, so let's dive a little bit deeper to understand why it's important for founders to understand both.
For sure, because bookkeeping and accounting go hand in hand. They're often confused for being the same thing. So as a startup, as a founder, you need to have financial control over the business. So bookkeeping would provide that data to have a clear understanding of the financial health. How's the company doing? What are the revenues? What are the cash requirements? What are the cash inflows and outflows? Once you have that financial data, decision-making comes into play for founders and startups so that you can interpret the financial data, make financial decisions that are essential. So for example, once you look at the income statements, balance sheets, cash flow statements, you need to have an understanding of how they're interrelated so that you can take effective decisions. Investor relations, again, I know I mentioned this before, but often investors, bankers, if you're looking for a loan, lending institutions, they require financial data. So they are also looking at the same financial reports that founders are. Having an understanding of those reports, founders can explain their financial situation and their growth patterns, their future forecasts to these stakeholders. Long-term planning and growth. Again, Everything is interconnected, everything feeds into one another, but accounting knowledge is essential for long-term planning and growth so that you can, based on, again, history, you can predict the future.
Yeah. The one thing I'll say is that when I was building my initial financial model, it helps so much to understand like current costs on a monthly basis. And so I could use that as a predictor of what future costs could be. And I could extrapolate it because I could go down finite to right now we have 3 employees, but let's say 6 months from now, if we plan on adding 3 more, here is what that looks like, and it makes it easier to actually look at it from a modeling perspective using real costs. I'd say than actually trying to think things up as separate exercises, because financial modeling, as you say, you use the real data to help you determine or create other tools that will give you the information that investor really needs, and it's based on reality and forecast. But as long as you have a good base, you're starting at a good place.
Yeah, think about it as a foundation, and then you build on the future predictions, the assumptions in the modeling, so that you have better results for decision making.
Okay, perfect. Thank you. So tell me about some of the initial steps that's involved in originating some of the bookkeeping data.
So I would say think about cash. Follow the money, as they say. So the starting point is usually bank statements, cash coming in, cash going out. When we start looking into bookkeeping, there are two bases of recognizing financial transactions. One is cash basis, which is purely based on what you have paid so far and what cash you have received so far. The other one is accrual basis, which is a bit more complicated because it has prepayments, deferrals, recognition criteria. So just to expand on it, cash revenue is only recognized when you receive a payment from a customer. That's your revenue because you have gotten the cash. And expenses are only recorded when cash is paid out. So if you see a withdrawal from your bank account, that's it, that's your expense. Accrual is a bit more involved basis. So under accrual basis, revenue would be recognized when the product is sold. When the revenue is earned, at that point, you would recognize it on your books. Similarly, for expenses, when expenses are incurred, that's when you would recognize it on your books. So I'll take a simple example of a utility bill as an example. Accrual basis would require you to look at the utility bill, see when the services were provided. Let's say if it's for the month of June, you record it in June. But under cash basis, it's when the cash is paid. So generally speaking, utility bills are due the following month. So under cash, the June bill, when it's paid in July, that's when you recognize it as an expense. Both have advantages and disadvantages. So cash basis it's simple, easy to use. You know where your cash is. You recognize based on the movement you see in a bank statement. And that's what's generally used by small businesses, early stages companies, sole proprietors, partnerships. So that's generally, they prefer cash just because of its simplicity. But accrual basis, it's more complex accounting. It requires adjustments for accruals, deferrals. It results in a timing difference between recognition versus cash. So you might have recognized revenue for a product or for a service today, but your cash flow might come in later. So there's always a timing difference to account for under accrual basis. Okay. And if you're following any specific framework, GAAP, any accounting, generally accepted accounting principles, then you would have no choice but to follow accrual basis. And I just want to add one small thing for tax. CRA does suggest accrual basis for businesses. However, they have a threshold for small businesses. The threshold is based on the annual gross revenues. And if you qualify, you can still use cash basis for your tax reporting. There's just certain rules you'd have to follow per CRA.
Because obviously what you're talking about has tax implications on when you recognize revenue, right? So even though, let's say you invoiced in the current year, but you didn't collect until the year later, does that revenue get recognized in the year that it's invoiced or on the year that it's collected?
Yeah, and it comes back down to cash versus accrual.
Okay, perfect. Basically. So tell me about the importance of classification when it comes to your financial transactions and why that's important for bookkeeping.
So I guess classification is essential for accrual, for accurate bookkeeping. You don't want your revenue being recognized as a liability. As an example, it's a sale. It should show up as a sale. So it's very essential that everything is tracked properly. Again, going down to the basics of bookkeeping, where transactions are being recorded accurately, and there are a few easy best practices that can be followed to ensure accurate bookkeeping. First is using standardized categories. So again, going back to my revenue example, sale should be consistently recorded under a sale account rather than an expense account, a receivable account. If it's a sale, it should be under sales. So using that standardized categories through understanding what kind of transactions are being recorded. Following accounting principles. Whether you choose cash or accrual, make sure you are consistent. So flip-flopping between the two will not result in accurate bookkeeping. Documenting supporting details. For instance, if you're recording an invoice, ensure it has some, unique ID or a description so that the transaction is easy to identify. Also, reviewing and reconciling. So yes, throughout the month, throughout the year, you're recording transactions, but review and reconciliation is a key process that ensures you're going back and ensuring your books balance, your balance sheet balances. So if you have periodic review process as part of bookkeeping, it would ensure that you're reconciling your records periodically, and it's not a mad dash at the end of the year to ensure, hey, why is my cash not tying to the bank statement? Or I thought I sold more. Why don't the books balance? I also want to add that for effective bookkeeping, there are multiple software tools that can assist. For instance, coding transactions, generating certain management reports. All these can be done with some use of software tools. And these tools, I'm not talking about a huge investment, but if you have invested in again, I'm going to use QuickBooks as an example. If you have invested in QuickBooks and you have access to that, it can help automate some of these processes for you.
Okay, that's great. I feel like you've already mentioned some of these things in my next question, which is the best practices. But let's crystallize some of those best practices from your perspective.
For sure. So
from first perspective, go ahead.
First of all, being consistent.
Yep.
Making sure you are consistent in reporting your transactions and the frequency in which the financial transactions are reported. I know, Hesse, you mentioned earlier about the crunch period, trying to get your numbers right within 2 weeks for the year. That's not what I would recommend. Periodically recording transactions is important. It could mean daily, weekly, even monthly, but once a year might be a stretch as you're just leaving everything at the end to reconcile and review. So ensure you have a periodic recording of transactions. Daily or weekly would be, if it's manageable, would be recommended. Also, double entry when you're thinking about recording a transaction. 2 accounts need to be impacted at least. So if you're receiving cash from a customer, you are receiving cash, but the other side, which might be sale of goods or providing services, that the other side also needs to be recorded. So don't have one-sided transactions as you're doing bookkeeping, to ensure the books are balanced, including relevant details. And entry 1 as a description for an entry might not be as useful and helpful when it comes to looking at the audit trail of what the transaction relates to. You could also consider digital filing. Now, most of the softwares available currently are cloud-based. So think about digital filing all the documents, all the relevant support, and ensuring they're obviously securely safe as well. And by doing some of these easy tasks that we, again, tend to not put in our forefront, you can ensure that the financial data is as accurate as possible, complete.
Okay, that's excellent. This is I'm actually taking down notes because this is something that half these things that you said, I'm like, I don't know if I do that. I don't know if I do that. But okay, so let's talk about a company who's bootstrapping, and they're going to weigh the costs of actually doing their books in-house versus outsourcing it. Give me some of the, I guess, the advantages of them deciding to outsource their work.
So for sure, outsourcing, there are multiple firms, multiple places, including my own, that offer outsourcing services. And when you look at some of the benefits, it's reduced payroll. Rather than hiring a full-time employee or even part-time employee to do the bookkeeping, you reduce those payroll costs, and you can, the outsourcing will have a charge, but they are the ones that specialize in these, in this industry, in this area. So their costs are not as high as having a part-time person doing the books for you. There's also elimination of training and recruitment costs. Once you hire the outsourcing firm, they're already trained. You don't need to train them. You have to explain your business model, but they can take on the transactions from there. Access to specialized expertise. As I said, these are individuals who excel in their field. So you would have access to the knowledge they have. If you have any questions, you can reach out to an expert rather than trying to research, trying to deal with anxiety on what the right answer might be. Also think about cost savings on software and technology. Yes, when you're small enough, you can keep track of transactions in an Excel, but eventually, as you grow, you would have to think about purchasing a software. But if you were to outsource the bookkeeping to a firm, they can take care of the software and tools because they would be recording the transactions in their own softwares. So you wouldn't be investing in purchasing a software license or maintaining it once you have gotten the license. Reduced error rate and compliance risks. If you have an expert doing the books for you, chances are they know what they're doing. You won't run into as many errors, a risk of errors, versus the books being done by someone who's not as financially, who doesn't have as much financial knowledge or is an expert in bookkeeping. So it does reduce the risk of errors. And compliance. So again, I focus on taxes. So I'm going to mention tax returns there are deadlines to file taxes by. So if you have a firm and you're outsourcing the bookkeeping service to a firm, they can ensure your books are ready by the set deadline. They're always ready to go so that you're not incurring any compliance risk from that perspective.
Okay. So let's go into some of the common challenges that startups are facing with bookkeeping. And I feel like the first one we kind of already touched on, because when we talked about limited financial resources that a company has, they don't necessarily have an accounting staff. So So from that perspective, you've already talked about the outsourced bookkeeping, which
Yeah.
is important. And by the way, doing the like putting entries into, let's say, a system is different from bookkeeping, right?
Yes.
Because I used to do the entries for all the expenses and all that in the system, but the bookkeeping was always done by a separate individual. And she typically was outsourced because in the beginning stages, we just didn't need her until the end of the month. That's typical?
Yes. The bookkeeping, uh, part of your entries is part, or entering the data is part of bookkeeping, but that's not what all bookkeeping entails. There's much more to it. And as you noted, you had to hire external help to at month end to get it done.
Okay. So, and we also say early stage companies who Altitude Accelerator supports, many of the startup founders, team members, they do multiple things. And bookkeeping is one of them. So, but it's not necessarily their bailiwick. So, what would you suggest from that perspective?
I would suggest having an established schedule for bookkeeping activities. It could be periodic, so think about weekly or monthly, where you have set time for just bookkeeping, ensuring that the transactions are complete. All the transactions have been communicated to the bookkeeper for bookkeeping, whatever the process might be. So I would say establish a regular schedule, set some time aside.
Okay. So let's say for companies that have irregular cash flow
Mhm.
and they struggle to manage some of their working capital effectively because of this. I mean, there are so many of them, like right now, that it's based on sale or it's based on promise, and it could be part of the transaction is it could be a quid pro quo. You know what I mean? It could be a partnership transaction without any cash actually exchanging hands. So when it comes to a little bit more of those complex situations, what do you suggest?
So when we're talking about cash flow management, part of cash flow management is implementing cash flow forecasting. So if you know what your historical data is, what your historical cash flow has been, what coming in, coming out, that would help you project the future cash flows so that you can monitor the cash flow regularly to anticipate any shortages and you can plan accordingly. Cash flow management entails multiple steps, but I would say that step one is start with cash flow projections, cash flow forecasting. So this is June, month end is coming. What are your anticipated payments out to vendors, to employees, payroll, and when are you anticipating cash in? What cash flow forecasting helps you is also negotiate with your vendors if you think you might be, cash strapped for the next few weeks, or you need more, better payment terms with your vendors. So once you have that data, which comes from bookkeeping, accounting, historical data, you can forecast what are your cash flow needs. So that's the basis of cash flow management.
Okay, thank you. One last question.
Mhm.
Tell me about the annual filing requirements and when they're due.
For sure, for sure. So, um, as a startup, as any business, if you have employees on your payroll, there are payroll remittances due to CRA. So, what I'm talking about is you have an employee, you're paying an employee, you are paying them after tax. The tax you are, deducting from the employee's gross pay is due to CRA. So there are payroll remittances that are due to CRA. There are sales tax requirements. So HST in Ontario, those have to be filed monthly or quarterly depending on what your gross sale threshold is, and they are to be filed with CRA. All these can be done online these days easily. Corporate taxes If you are a corporation, you have tax return, which is T2, due every year. Now, I've seen most startups have a December, or most companies have a December 31st year end, but you can choose any other year end. It all depends on what you're planning, what period makes sense for you. I work with a lot of companies where their year end is February, March, June, July, or December is, again, I'll agree, the most common year end I see, but there are other non-standard which are not based on calendar years. So T2, corporate tax, that's another compliance annual filing requirement that's due. There might be bank requirements as well. So if you have a bank loan, they might have financial reporting requirements, covenant requirements. So that's very specific to the bank and the type of the loan you have. But you have to also be mindful of bank requirements.
Okay. My goodness, I'm overwhelmed. I feel like there's so many more questions that I need to ask, but we do have to end it at some point. So if people wanted to get more information and learn more about the processes and tools and best practices, where could they reach you?
You can reach me at my email. It's Tanvi, Tanvi .gupta, Gupta @mnp.ca. You can reach out to me on LinkedIn as well. Again, Tanvi Gupta. So there aren't that many of us, so I hope you don't struggle searching. But yeah, please feel free to reach out to me. I would be happy to address any questions, any comments you might have.
That's amazing. Thank you so much. That's all we have time for today. And Tanvi, you've been amazing in helping us shine a spotlight on this. And it really is not a boring topic. I actually learned so much from you today, believe it or not. And my husband is an accountant. So that is amazing. It doesn't mean that I don't listen to him. It just means that the way you've laid it out is so much more appealing than I get.
Thanks, Hesiem. I don't know if your husband's listening to this, but I hope he doesn't mind.
Hopefully not either. Anyway, thank you so much again. And for our audience, thank you for joining. If you have topics that you want us to cover, please don't hesitate to email us at communications@altitudeaccelerator.ca. Tech Uncensored is powered and produced by Altitude Accelerator. You can find us on Spotify and wherever you get your podcasts. And until next time, I'm Hetty Jones. Have fun and stay safe.